Well, we've been Apple fanatics since 2008. We converted our whole office to Apple laptops, an Apple server, Apple routers, and the whole world has gone Apple crazy. So as a portfolio manager, we often get asked, why do you hold Microsoft in your portfolio when you're an Apple fanatic? So let's take a quick 4 to 5 minutes to look at an interesting comparison between these two companies. And it's interesting because in October of 2012, these companies are looking very similar for the first time in many, many years. Apple started in 1976. Well, Microsoft and Apple, from an operational review standpoint, are very similar. They both have tons of employees. You could almost argue a similar amount, although the Apple employees have a larger percentage that are sort of retail clerks, less skilled. But when it comes to things like their debt levels and net assets, well, Apple is debt-free at the moment, but their net asset position is almost identical, the amount of things they own free of debt. Their cash positions, you hear a lot about Apple's cash position, but in reality they both have a ton of cash. Microsoft has even more, at close to $50 billion. That's never seen in history. It's very interesting and it's huge. Both are cash rich. Both have a high level of sales, and for the first time in many, many years, maybe ever, Apple has now outsold Microsoft at just over $100 billion in sales in the last fiscal year. When you look at classic investment analysis, we run a quant model, it's called. We're portfolio managers. We actually financially model these companies. And one of the things we do is we calculate, based on the risk of that company, what their earnings have to grow, what rate they have to grow at to justify the current share price. And in our quant model, we're coming up with comparable earnings growth assumptions, 6.9 on Microsoft, 9.8 on Apple, much lower than what they have been doing in recent years. Their classic ratios, price to earnings, price to sales, price to book, all very comparable. So when you're looking at these two companies, you've got to wonder, why would you not consider holding Apple, or why wouldn't you be holding Apple when you hold Microsoft? And the thing is Apple, and a visualization will help with this, Apple is a little bit like a teenager who grabs a 10-speed bicycle and then just jumps on it and rides like crazy to catch up to the Tour de France. That sounds, a little bit far-fetched, but it really isn't that bad when you look at Apple's operations. They are considered a computer manufacturer and retailer, but here in 2012, they sell just over 10% of their total sales in computers. 1/10 of their sales are in computers. 90% of their sales are in other things. Well, they revolutionized the music industry with their iTunes and the delivery of music through their iTunes store, and now movies, and soon to be books. Well, this revolution has led to less than, or around about, 3% of their gross sales. iTunes sales are only about 3% of the total things that Apple does. Where does all of their revenue come from? It's the iPhone. The iPhone, which is now only 5 years old. 5 years ago, Apple wasn't even considered in the market of the cell phone providers. 55% of their sales, actually 56%, comes from the iPhone. Yeah, the iPhone is amazing. It's revolutionary. The iPhone 5 is now selling out and hitting impressive numbers, but in reality, there are a number of smartphone manufacturers. Nokia, Google is coming out with a phone, Motorola, might see something from BlackBerry, Facebook is talking about a phone, Samsung with their Galaxy have a very strong phone. They're all in a life and death battle to catch up and steal back some market share from Apple. Very competitive market. And when you find out that Apple is over 55% all on one product that is less than 5 years old, it changes the picture a little bit. At least it does for us. Compare that to Microsoft. Microsoft been around as many years as Apple. They've had a very stable base of operations. Over 85% of Microsoft's revenue comes from two products, Microsoft Office and Microsoft Windows. And even when you buy an Apple product, you're very likely going to be running the Microsoft Office product on your Mac, as we do in our office. The thing about Microsoft is they're not cool. So they have lots of upside potential if they can find a way to steal back a little bit of that cool factor from Apple, which they're trying very hard to do. They're also going to launch some hardware, which is relatively new for Microsoft. They're going to launch a tablet coming up, and that tablet's going to try and take some market share from Apple's iPad. And they're also going to do that with some retail locations, which is what Apple did. So there is a chase going on with Apple, and when you're being chased by a monster like Microsoft, that isn't such a good thing if you're Apple, because Microsoft has lots of upside potential if they can just take a little piece of the success that Apple has proven. Well, Microsoft shares, they haven't performed well in the last decade. They've only grown at about 2.7% on average, but they have had some good recent share price performance. They've easily recovered from the 2008 recession. And what's crazy about a company like Microsoft, they've been growing their earnings in the last decade at almost 14% when their shares have grown at less than 3%. How can you grow your organization at 14% or near 14% and not even see a 3% appreciation in your share value? That makes Microsoft a bit of a value play in the tech industry, which is a very rare thing indeed. Their dividend policy, which has been in place since 0304, has shown a strong and stable growth pattern, like in the 20% range, and their dividend yield's currently at 1.9%. Microsoft, certainly a more stable, lower risk, more predictable entity, and appropriate for retirement and pension money. That's our overview on Apple versus Microsoft from an investment perspective. My name's Ian Quigley. I'm from Qube Investment Management in Edmonton, Alberta.